Good afternoon, good evening, good morning, wherever you are in the world, and welcome to Valutrades webinar on setting your goals and following your plan. This webinar is based for not just beginning traders, but intermediate and advanced traders, and I hope you'll be able to glean something from this. Please feel free to drop a line onto the chat line or the question line on your webinar, and I'll be glad to answer as we go along. My name is Brad Alexander. You may know me from other Valutrades endeavors. I do the market blasts every Monday and Tuesday morning. I'm a trader, retail and professional. I provide content for Valutrades, of course, and other entities like fintech companies and brokers and educators. I'm also an educator. I've been trading for a very long time. I've had the ups and downs. I've worked on all sides of the business, including brokers, including fintech companies and educators. So I like to bring hopefully a wealth of experience to our Valutrades webinars, and hope you'll be able to take something away from this. But before we get going, of course, we have our disclaimer. CFDs and FX are leverage products and your capital may be at risk. If you don't understand the risks involved, please take a look at the disclaimers on the Valutrades website, or just pop onto the chat line on Valutrades and someone can easily answer all your questions about trading. Never trade more money than you can afford to lose. Start off with small amounts. Obviously, you start with a demo account, and by all means have fun, but don't go crazy. And please read the disclaimers on the Valutrades websites. Okay, I'm going to do something a little different this time. I'm going to actually read the webinar topics that came off of the website because it actually is very well written and it's very valuable for the overall view of this particular webinar. So it says the very best traders have the ability to adapt and change their strategy based on what new information the market presents. So I'm going to be going through quite a lot in this webinar today, looking at not just strategies and how to put them into practice, but there's nothing wrong with changing a strategy. If something doesn't work, you need to change it and make it work for you. And you need to be looking at the types of trading you want to do, the risk tolerance that you have. Whatever makes you more comfortable and confident is the best thing that you can do for your own trading. And I'll be going through a lot of things about pre-analysis, post-analysis, post-trade analysis, and so forth to help you along your journey of setting your goals and making some money on in this wonderful venture. So that's why each year it's important to evaluate your strategy, set goals, and to commit to executing your strategy. I mean, here we are in the beginning of the new year. We always like to make New Year's resolutions. My New Year's resolution this year was to stop watching American news. Well, what has that got to do with trading? It sounds like nothing, but I'll be really honest with you. I find that what's going on these days a bit depressing and distracting, and that's the last thing I need. I watch Bloomberg all day long, and I watch Eurosport, and it keeps me in tune with the markets. But I try to avoid things that will distract me, and I find that helps me be a better trader. If I can focus on the markets and not having things in my life that distract me, it's far better for me. And we'll be going through a few things like that in our section on trading psychology. In this webinar, we'll discuss how to set new trading goals for the year, how to stick to your strategy, and the danger of letting emotions get in the way of executing your plan. Well, that's all about trading psychology. And if you're a new trader, a beginning trader, you may hear us talking about trading psychology and you really maybe not know what that is. And it's one of those things in life that you don't know you need it until you need it. And trading psychology can sneak up on you if you're not careful. So the way I like to look at trading psychology, the first thing you need to do is to be able to be confident and comfortable with the tools that you're working with. So the first thing you need to do is get a demo account if you're a beginning trader, get to know the platform, get to know how price action works. And we have lots and lots of webinars and lessons on that. And the analogy I like to use is if you're driving a car, they don't let you give you a set of keys and go drive a car. You take lessons, you take theory, you maybe drive in a simulator before you actually get out on the road. If someone gave you a set of keys and you jumped in your dad's car and drove out on the road and killed someone, it wouldn't be very pleasant for anyone. And it's the same with trading. If you just throw a lot of money into a trading account with no education, no idea about trading psychology, and just blew up your account, you wouldn't like it at all. And they say the the best way to learn how to make money in Forex is to lose a lot of money at it. Well, what if that were true for doctors and bus drivers? No, they go through a lot of training. They go through a lot of practice and theory before they're allowed to perform their task. And especially if you're an airline pilot, you go through hours and hours and hours of simulator training. They throw every scenario at you, every problem, every landing, every takeoff. And that's the way it should be for traders. So before you get involved in trading, if you're a beginning trader, really get to know your equipment that you're using before you start throwing a lot of money at it. And that's one of the premises of trading psychology, is you really need to know what you're working with, and you need to be comfortable with the markets. So in this webinar, here's a quick agenda. As we talked about setting your goals. Well, what are goals? I mean, if you're a trader, you could have all kinds of goals. I mean, a goal could be this year, don't do anything stupid. A goal could be, oh, I want to increase my percentage. I may want to increase my risk reward ratio. I may want to look at a higher percentage per day of trades. I may want not to lose money. That's a goal. There are lots of ways to look at goals. I may want to explore different markets. Let's say I'm a Forex trader and I'd like to know more about the indices or maybe metals. That can be a goal. There are lots of ways to look at it. I want to look at trading metrics, and trading metrics are basically post-trade analysis. And it's very important to understand what you're doing with your trades. I mean, you can look at the bottom of MT4 and see your account history, but it may not be telling you the whole story. And I'm going to show you how to look at your trades, post-trades, after the fact, to analyze what you're doing right, and what you're doing wrong. And there are lots of other services where you can actually plug in your Valutrades MT4 account, and it'll give you a very, very pretty charts and graphs. Yeah, that's post-trade analysis. Also pre-trade setup. And again, I'm going to be harping on this about trading psychology. If you don't have a plan, if you don't understand the tools you're working with, if you're not confident with the markets, you will quite simply fail. So we need to be very careful with our pre-trade setup, understand what we're trading, understand why, and basically follow our plan. I was recently asked to participate in a series of interviews with a financial outlet, and they asked several professional traders and educators, a list of questions, and we all come up with different answers. But there was one at the very end, and it was quite simple: what makes a successful trader? And my answer was someone who can stick to their plan. And I looked at a lot of other answers from other different professionals, and they had the same thing. They basically said, discipline, 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 stick to your plan. It was all the same right across the board. And you simply can't beat that. So we want to look at making a trading plan. We want to look at trading psychology. And again, maybe a boring topic for a lot of people. Say, I don't need trading psychology. I don't need to understand it. But I've found out over the years that you do. And even experienced professionals will fall into certain traps. I mean, I'll give you a quick anecdote. I used to do a lot of networking in London, and I had a good friend who was an options trader. And her full-time job was a coach. She wasn't a full psychologist, but she was a life coach. And she told me once over coffee that most of her clients were London City traders. And the biggest problem they had wasn't because they didn't have confidence, they didn't understand what they were doing. It was because they got overconfident and they started making mistakes. And this can be a real problem for beginning traders, and even obviously experienced traders. I like to use an analogy of golf. If any of you out there golf, you realize, and you take a lesson, it's not the most natural thing in the world. You watch the pros swing their clubs at the ball, and it looks beautiful and natural. Well, it's actually a very technical thing to do. So when we first start golfing with no lessons, we go out there and we try to hit the ball as hard as we can, and if we make a bad shot, we just hit it harder and hit it more often. And that's the same with trading. You start making bad trades, and you take revenge on the market. You start making more trades, and you increase your position size because you're upset, and that's just the worst thing you can do. But on the other side of the coin, you're out there duffing away at your golf ball and taking up lots of divots, and then suddenly you hit the most amazing drive you've ever seen, and the ball sails and it's beautiful and you're so impressed. The worst thing you can do at that moment is to think, I've got this game licked. I understand what I'm doing. And it's the same with trading. we as educators and even brokers hear the same story for years and years about someone who's opened up an account, maybe put in 500 or 1,000 pounds or dollars, and tripled their money within a week, and then by the next week they've lost it all. Ha ha ha. And that's a very, very common story because they simply get cocky. They simply make some good trades. They don't know why they made some good trades. Chances are they got very lucky. If you tripled your money in a week, I hate to say it, you're doing something wrong, because that's not what's supposed to happen. That's actually gambling. Your position size was too high and you got lucky. So, and again, I'm going back to my friend who said her main source of clients were London City professional traders who are overconfident. That's an important lesson to learn. Okay, and also I'm going to go back to Valutrade signals. You may have seen other webinars and videos that we've done, that I've done on Valutrade signals. You can use Valutrade signals to actually eliminate trading psychology. If you're not confident doing your own analysis, whether it's fundamental or technical, or have the time to keep up with the markets, there's no reason why you can't use Valutrade signals. And one thing I'm going to talk about in this webinar is the actual confidence level. So whatever works for you, it frees up your time, allows you to trade the strategy and the time frame you want to trade, and increases your confidence. Valutrade signals might be a way to go. So we talked about setting goals, and here we are again in the new year. What are trading goals? Well, as I mentioned, there are quite a few ways to look at trading goals. So let's look at it from the standpoint of the type of trader you are. Okay, let's say you're a beginning trader. And I would highly recommend, if you're a beginning trader, in the first month or 2 or even 3 months, if you break even, I'll be very proud of you. As I said, we don't want you to throw a lot of money into an account and blow it up and lose all your money and learn that way. If you can maintain your composure, stick to your plan, find a decent strategy that you like and you're confident with, and you can break even after even a few weeks or even a month, you've done very well. And that doesn't sound like a great way to earn money, but trust me, I've seen a lot of these things over the years, and if you can break even after a long session of trading, and I don't mean a day trade, I mean, a good solid record over a few weeks or a month, you've done well. So be proud of yourself if you can break even. And then you look at how I can augment my strategy, how I can maybe change my plan, how I can increase my confidence, maybe change symbols, and start making some money. Right. Again, for beginning traders, learn your tools and study. I mentioned this earlier. You sign up with a Valutrades account and you see MT4 and it's all very colorful, and I've got lots of videos that shows you how to change the colors of the candles, and there's a lot more to it than that. Obviously, there's a lot of indicators, a lot of different time frames. Feel free to set your goal to learn more about the equipment that you have. You may find an indicator you'd never heard of before that may help you trade. You may not realize what backtesting is all about. Maybe spend more time backtesting and study. Take a look at there's a plethora of strategies online that you can take a look at and learn. So if you're a beginning trader, learning is a very, very good goal for the new year. Okay, and find a strategy that works for you. Spend the time finding a strategy. And as backtest, there's a lot of easy ways to backtest indicators, especially lagging indicators, and find one that works for you. And also find a time frame that works for you. And if you're busy with a 9-to-5 job and your boss doesn't want you trading all day long, then scalping the news may not be a good strategy for you. If you've got if you can trade on the 4-hour time frame and you can do swing trading or even intraday trading or position trading, which is long term, and just check your charts once in a while, check maybe in the mornings, in the evenings, maybe at lunchtime, that is something for you to set as a goal, to refine your strategy, to refine the kind of trader that you want to be that works for you. Like I say, there's no point, if you're distracted by whatever and you want to be a scalper, that's just not going to work. But if you've got a 9-to-5 job and you only have a certain amount of time that you can take a look at the charts and maybe analyze the news and maybe get a highlight off Yahoo Finance or Bloomberg, that you need to be refining that. So if your goals for this year could be to try to break even with your new strategy, learn some more about your tools and the markets, find a strategy that works for you, and create a plan. I'm going to show you later on in this webinar about creating a plan. And again, I'm going to repeat that interview that I went through. The question was, what makes a successful trader? Sticking to your plan and being disciplined. 2 seconds, please. So for intermediate traders, and these can apply to beginning traders as well. If you're an intermediate trader, hopefully you've gone past the point of wanting to break even. If you're an intermediate trader, then maybe a goal this year could be to stabilize your percentage target of profit, and of course not loss. And what does that mean? Well, if people are saying, hey, I'm making 30% a month or I'm making 30% a week on my trading account, there's probably something wrong. That's a lot of money to be making. A lot of professionals, I mean, I know a hedge fund, they're looking at 5% per month. I used to trade with an American hedge fund, and if we did 1% per month, they were over the moon. They loved us. That, of course, we were trading with a lot of money. So your target of achieving a percentage per week or per month or per day doesn't have to be an insane amount of money. You know, again, if you're doubling your money in a couple of months, well, that's amazing. But you may be doing something wrong, believe it or not. If you want to be a professional trader, you need to have a more stable level. And as I said, if you know, when we were trading professionally with a certain hedge fund, I've worked with various companies before, and their target was 1% per month. And that doesn't sound like much, but if you compare that to what you're getting at the bank, and if you've got investors or a fund with a lot of money, that can be a good return. Okay. Intermediate traders, a goal for this year is analyze your past trades. And I'm going to show you some post-trade analysis tips as we go along. Because very often, if you're plodding along and you're trading certain pairs that may not be working for you, you may be trading a market that you don't understand, like metals or indices. It's important to take a really good look at where you've gone right and where you've gone wrong. So a goal for this year for intermediate traders could be to analyze your past trades. And after you do that, modify your strategy. And of course, hopefully you've got a plan. I want you to make a plan if you're moving forward. There's nothing wrong with modifying your strategy, especially if you have a very technically based strategy. Very often you'll find, I've seen some people that create these super crazy, complicated combinations of Bollinger Bands and Heikin-Ashi candles and fractals and so forth, and they say, hey, they make a lot of money for a month, and then suddenly it doesn't work anymore. There could be two reasons for that. It could be that the market has caught on to it, or it could be that it probably never worked in the first place and you just got lucky. So modifying your strategy, even tweaking things like moving averages, is not a problem as long as you have a plan to start with. Modifying the plan is not a problem. And to learn more about the markets, your goal as an intermediate trader could be to learn more about the markets. I mean, I for example, I have Bloomberg on all the time because I need to know what's going on. I don't base my trades based on what I hear on Bloomberg, but it definitely keeps me, up to scratch with certain things that are going on. And when I say learn more about the markets, one of the rules that we're going to be going through later is checking the economic calendar, and beginning traders as well. Could be a goal for you to put on your plan, is before you start trading every day is check the calendar, because there's nothing like running into a news event you didn't know. I remember years ago I was selling indicators that were basically liquidity mapping, and I asked a trader, I said, do you ever trade the news? And he says, only by accident. It was a funny answer, but that does happen. If you're not paying attention, then you could be running into some problems. So that's a goal to add to your list, is to learn more about the markets, and that includes checking the economic calendar every day before you trade. Okay, for advanced traders, it's the same thing. I want you should be taking a look at what you can achieve as a percent every day. And for advanced traders, there's a reason for that. And I want you to be able to prove it. I mean, there are lots of ways you can plug your MT4 account into various services, and it'll give you pretty graphs and charts. And the reason I want you to prove it is not just to prove to yourself that you can do it. If you're an advanced trader, you've probably gone through a lot of the things that we've just talked about, but you should be able to show a chart that shows a very wonderful looking progression of profit and go looking for investors. I mean, I get people contacting me all the time, either for me to trade for them, and I don't, or people looking to trade. And I get sent these crazy graphs with huge spikes in price. And there's no way that anyone's going to hire you as a trader if you have these big spikes. It means you got lucky. And an investor doesn't want to gamble. They could go to Vegas and gamble on their own. If they're looking for traders, they're looking for someone with a very nice, steady progression of profit. And I'll show you some examples later on in the lesson. So, and the next goal this week could be to become a professional. And to do that, again, and going back to the very first goal, achieve a percentage target. And again, it could be 1%, could be 2% per month. Be able to prove it, show it to an investor, and show it to a fund. You may, if you want to be a professional trader, there's no reason that you can't find a fund that will hire you if you have a proper track record. And they'll want to see a floating P&L. They don't want to see the actual the final results. And a floating P&L means that if you're trading without a stop loss and your profit level is going up and down with open trades, they'll know. You need to be able to prove that you can manage your risk. So that's so there's some goals there for this year and for all time, basically. So great. So let's say you're an intermediate trader or an advanced trader, and you want to look at your metrics. And beginning traders, you should know that this is coming up, and these are. And you can't get trading metrics without putting some trades in. You need to have some track record first. So basically, you need to be able to look back at your systems and say, what are you trading? And here's a quick chart that I've got from years gone by, and it shows a trader's record and where they were doing very well. And it looks like in this particular chart that pound yen was a very, very active pair for them, and Aussie dollar was the least active. There's nothing wrong with that. I mean, I recall going through periods of trading years ago where I simply did not trade the Australian dollar at all. I was almost jinxed by it. So there's nothing wrong with eliminating a pair or gold or indices from your trading plan or strategy if it's not working for you. And I'll tell you, I was trading with a Malaysian hedge fund, and it turned out about 3 years ago, and it turned 4 years ago. It turned out about that most of what I was trading was then the Australian dollar, and I did very well. So the markets changed, my knowledge of that pair changed, and that was part of my goal. And I learned more about what the Australian dollar was going to do with certain pairs, and I took advantage of it, and I made a lot of trades based on Aussie dollar and Aussie CAD and so forth. And I was able to change my strategy based on a pair that started behaving differently for me, and there's nothing wrong with that. And I may have eliminated some other pairs that weren't working. Sometimes the yen doesn't work for me, or maybe for you. I know I've met a guy running a hedge fund. He says, I can't trade gold anymore. It just doesn't work for me. I love trading gold sometimes, but sometimes it can bite you depending on the fundamentals. So you need to be able to take a look at the pairs you're trading and be able to adjust. Okay, how is your P&L? We talked about your profit and loss. Here's a particular chart that you can get from any service when you plug in your MT4 platform. And it looks like from one end to the other, this particular trader has actually made money. But this is probably not the kind of P&L chart you want to show to an investor because it is a bit erratic. There's some spikes in profit, but there's also long periods of loss. But these services will show you where you're going wrong or going right. So in this particular case, if you line up the timeline of this profit and loss chart with the actual market that you happen to be trading, and this is a very simplistic example, you'll find that this trader made more money, had more profit during trending markets, and clearly was not happy with ranging markets. And there are many good reasons for that. We've done lots of other webinars on ranging markets versus trending markets and so forth, and I won't go into all the details, and a lot of traders refuse to trade ranging markets. And in this particular trader, you can see why. So you need to understand the type of trader you want to be and what works for you and what doesn't. Okay, here's another case where this P&L was bad. It was, you can see, below zero. So clearly this trader was constantly losing money, but his biggest losses came during times of high volatility. And that gets back to, as I mentioned earlier, understanding the market, being confident, and looking at the economic calendar. Clearly, he really wasn't paying attention. Trades were open, or maybe open trades during volatile times, and it just didn't work. So this is a case where you need to, and your goal should be to understand more about the market. Here's another one, the exact same thing. A big news event caused a big loss for this particular trader, simply by, and it happens all the time. We weren't paying attention, didn't know something was coming up. And of course, there are things that happened, geopolitical events that you don't see coming at all. And this is where you need to be able to be confident about your risk management. So if you're not using your risk management properly, add that to your goals. Okay, these particular services can analyze your best trades and your worst trades. In this particular case, this trader had some great trades with pound dollar, euro yen, another one with euro yen. His bad trades were pound yen and euro dollar. So maybe there's a reason for that. Maybe he or she doesn't understand the market. And as I was saying earlier, if you're finding out you understand more about pound dollar for various reasons, maybe you like to follow UK politics, then stick with it. Okay, risk reward ratio, and this is critical to understand, especially for beginning traders. And a risk reward ratio gets right back to risk management. And I'm going to talk in a second about how this can go wrong. So basically, the average profit and loss of winning trades divided by the average profit and loss of losing trades is your risk reward ratio. So if your risk reward ratio is 2 to 1, that means that your winning trades are twice as large as your losing trades, which is a very good situation to be in. And that gets back to your stop loss. We've done lots and lots of videos on setting your stop loss. And if you want to set your stop loss, above the last swing high, and your take profit is on a sell trade down below, in the next zone of resistance, a zone of support, I should say, you need to have a gap between your entry price and your stop loss, and also a nicer gap between that and your take profit. That's your risk reward ratio. If you keep your risk reward ratio too tight, if your stop losses are too far away from are larger than your profit, what's going to happen is you're going to be making some profit, but your stops, your losing trades, are going to outweigh your winning trades. And another thing that we fall into is that some traders who don't even use stop losses, which is not a good idea. You may find that you'll be in a losing trade for days, weeks, and months, and when it finally goes above your entry point, you close the trade for a very, very tiny profit. That does not help your risk reward ratio, because those trades that you did have your stop loss on and you lost money will outweigh the winning trades. So you need to be very careful with your risk reward ratio and your risk management. So again, looking at patterns, this is part of your goal, and part of your trading plan is to be very careful with your risk management and risk reward ratio. So in this case, here's a very good chart. You can see the green bars are much higher than the red bars, because this particular trader had profits of 5 winning trades at $200 average and 5 losing trades losing $100 average. So his risk reward ratio was 2 to 1. Very simple calculation, but you need to be very careful about these things. You need to combine that with your win rate. So let's say you win only one half of the trades you place. Let's say you placed 10 trades and you only were profitable on 5 trades. Well, it's 50% win rate. There's nothing wrong with that, as long as your risk reward ratio is the right way. So you don't need to win every single trade to make money in trading, as long as your risk reward ratio is there. If your win rate is very, very low, like 10%, then you've got a lot of work to do. If your win rate is very, very high, good for you, but you don't have to have a very high win rate to make money trading. And here's why. Your as long as your risk reward ratio is positive and your win rate is 50% or higher, you can make money at the end of the day. And here's what happens. This is a very nice P&L curve, profit and loss chart, I should say. It looks very boring. It starts off at zero, obviously, and moves up very slowly over a period of months. Well, if you show this to an investor, you'll be hired as a trader. It's because it's that good. That's what an investor is looking for. They're looking for a nice, steady climb in profits. Very little. I mean, there's a couple of points where this trader lost a bit of money, but that's going to happen. So your goal for this year should be to calm down, try to keep your risk management under control, and create a P&L curve that looks like a chart that looks like this. If you're a beginning trader, you should be proud of yourself. If you're an intermediate trader and you do this, then you're clearly getting somewhere and you're improving your results. If you're an advanced trader, you can take this particular P&L chart, look for investors, and become a professional. There are a lot of ways to make money at this, and it's not always the best to try and trade your own money. Trading other people's money is far more profitable because they generally have more money. However, getting back to trading psychology, some people can't do that, and you need to know that before you get involved. Some people, on the other hand, are better trading other people's money than they are trading their own money, and that's an ideal situation to be in, but it's more difficult to get a track record. Okay, so again, looking at trading success versus trading failure. So trading success means creating a plan. I mean, I can't emphasize that enough. And then follow it. So discipline is critical. So creating a trading plan is important. Following it is even more important. And it's so easy to fall off the wagon that we say. You know, you may see an opportunity and you just get excited, or you hear a news item that's going on, and you say, oh, I'm gonna go long on euro dollar because I heard this on the news, and you forgot to check. You forgot to go back to your plan. You forgot to check support and resistance. You forgot to see what news events are coming up. You just get excited and place a trade, and that's where it all goes wrong. You didn't follow your plan. And as I said many times, applying proper risk management is very, very important in being disciplined. So trading failure, as you know, as our colleagues pointed out, was first of all not to create a plan. You have a plan, but you ignore it. You don't use risk management, and you succumb to trading psychology. Well, succumbing to trading psychology is a factor of not knowing what you're doing in the first place. And again, it's going back to the you can say, hey, I know how to drive a car, even though I've never had a lesson. Here are the keys, go get in. And you may be able to go down the road. You have the steering wheel, you have your accelerator, you have your brake pedal, and you may know how to use it, and you may be fine by the time you get down the road. But then what if something happens? Somebody pulls in front of you, or you hit an icy patch on the road. You need to know what to do with that car before something goes dramatically wrong. And that's all about understanding your tools and your indicators and your platform. So if you follow your plan, understand what you're doing, know what's coming up on the economic calendar, you may not even need to worry about trading psychology. So here's a little checklist. So develop a trading system or strategy. So I'm not going to spend lots of time on this webinar looking at different strategies. We could be doing that forever. We've done lots of webinars on different strategies. It's up to you as a trader to decide what time frames you want to trade, what indicators you want to use, if any. I know traders who don't use any indicators. They only go by fundamentals. I also know vice versa. I know people who strictly trade fractals or Bollinger Bands or Heikin-Ashi with Fibonacci, but they have a plan and they know when they're getting into the market, when they're getting out, and what their risk is. So you need to be able to decide over a period of time what your strategy is going to be and to write it down. You need, and again, using the right time frames. So here's something I'd like to show to anyone, basically, and mostly. In fact, I had a student who actually put this on a poster and stuck it on his wall. When I'm trading, or even doing analysis, I have an order that I look at. And I think if you want to understand more about the markets and your goals, this to me is a good one. You don't have to follow this verbatim, but this is what I use. And in fact, if you listen to my Market Blast videos on Mondays and Tuesdays, you will often hear me say, here's a technical opportunity, but watch the fundamentals on this because blah, blah, blah. And I put fundamental analysis on top of everything. If I see a wonderful technical opportunity, whether it's a chart pattern or stochastics are overbought or it's bounced off Fibonacci, that's all very nice and well, but I want to go back and take a look at the fundamentals, and that includes news items, finding out what happened recently to that particular economy before I even get into a trade. Next, I look at support and resistance. And again, you can get excited about some news item you've heard, or a friend of yours is short on oil, and you jump into the trade without actually checking the most fundamental, basic thing of all for trading: support and resistance. Many people have gone wrong going long on a position when they're too close to resistance, or going short when they're too close to support, and the price bounces and goes the other way. So fundamental analysis, check your support and resistance. Then I like to look at my chart patterns, and if you follow my Tuesday videos, you know how much I love chart patterns. Then I follow my indicators like stochastics or a Fibonacci. And Fibonacci, by the way, is not an indicator, it's a graphic, but it does work. And then I like to confirm that with candle patterns. If I don't see a candle pattern, I'm not really bothered, but it's always good to have confirmation. So when I'm trading, and this is part of my plan, look at the fundamental analysis, the economic calendar, check support and resistance, maybe entering on a chart pattern, maybe entering on indicators and candlestick patterns. But this is all part of my plan. So please take this seriously. Okay, confidence. We talked about learning more about the markets and being confident. And there's a lot of ways to build confidence and create your own confidence. And one way is to do what I call a strong week analysis. And it forces you to look at your plan. And in the beginning of the week, take a look at all, if you'd like to trade Forex, all the different currencies. And I do this, if you may have seen even the video I did today, I talked about the Kiwi dollar, New Zealand dollar. It was the weakest currency in the lot. And that gives me confidence because I typically know what, which way the markets are going. In this particular chart, I'm actually looking at the American dollar, and you can see by the direction of different pairs that it's actually the strongest of the lot. And as I mentioned, the New Zealand dollar is the weakest of the lot. So I can go doing my analysis or looking at my charts, and I know full well that the American dollar overall is strong. I know that the New Zealand dollar is weak. In fact, just as a hint, the Japanese yen was also strong. So I can go into my analysis looking at various pairs with the back of my mind knowing that one currency is strong, one currency is weak, and it just gives me that much more confidence and information. So I may say, okay, there's a good opportunity on Euro Swiss, but wait a minute, I already know that Swiss is trending strong against every other currency. Do I really need to be looking at this particular pair? If it's going in the same direction, then I've got the confidence to get into that trade. And it could be the same with metals. It could be the same with oil. And if you'd like to trade the Canadian dollar, you need to be very aware of what the oil market is doing. And I'll give you a quick example. I remember I was scalping the Canadian dollar once, and I had 2 or 3 trades in a row that went very well, and suddenly the price action went the wrong way. And what I didn't know, there was what they call a Baker Hughes rig count that came out at that very moment, and I didn't check the economic calendar, didn't know it was coming, and I lost that trade. And if I'd known, I would have stopped trading. I would have stuck to my plan, and I would have made that trade. So confidence is everything in this market. And if you're doing a strong week analysis, it takes minutes to do this. I set up my profiles in MT4. Here's a Kiwi dollar profile where I found the weak currency, and they're quite simple. So I have profiles for every single currency: dollar, euro, Swiss franc, yen, etc. Okay, again, I mentioned economic calendar. Before you even look at the charts, you really need to be aware of the economic calendar and what's going to happen that particular day. And you could be literally kicking yourself after the trading day because a trade you thought was great, it was technically wonderful, whether it was Bollinger Bands or Fibonacci or moving average crosses, and then suddenly, wham, the price goes in the wrong way, hits your stop loss. And you could have saved yourself a lot of grief and a lost trade by checking the economic calendar. So that's part of your plan, part of your goal before you get going is check that. And market information. And this particular screenshot is of Bloomberg. It doesn't have to be Bloomberg. You may not be able to watch TV or your app while you're at work, but there are a lot of other sites that give you financial information as you go along, like Yahoo Finance or Google Finance. Seeking Alpha, there FX Street, for example. There are lots and lots of sites that can keep you up to date with what's going on. If you find certain commentaries are contradictory to each other, there could be a problem. You may want to avoid that, but leave that as part of your plan and part of your market knowledge. And part of that is again building confidence. So strong week analysis, checking the calendar, and perhaps checking with financial news outlets, whether it's a website or a television show, and seeing what's going on in the markets and seeing what could be coming up and finding opportunities. Okay, so here's a plan. And this is quite a simple way to do it. And I've basically put this on a spreadsheet. And this is not necessarily a great strategy. I just use it as an example. But once you determine what your strategy is going to be, what you like, you may not. I know traders who hate using moving average crosses. I know traders who make a living using moving average crosses. If you know me, I like to use chart patterns and stochastics. Other traders like to live and breathe with candle patterns and MACD. Whatever works for you. I'm not going to spend lots and lots of time going through different strategies, but when you find a strategy that works for you, start making a plan. So if I look at this particular strategy, what is it about? Well, it's about any pair of Forex. It's based on the 4-hour chart. And in this case, a sell situation would be where the 8 exponential moving average crosses the 34 period moving average on the way down. Okay, that may not be the entry point, but price needs to be below a line of resistance. MACD needs to indicate overbought. I need to be able to set a stop loss at a swing high. And my philosophy is, if there's no place to set a stop loss, then there's no trade. If it's a one-way market, and you decide that you want to go against it, a fool and his money are soon parted. If there's no place to put a stop loss, then there's no trade. And you need to be able to find the take profit at the next line of support. And that gets right back to your risk-reward ratio. So you need to be able to incorporate the risk-reward situation into your trading plan. If the nearest level of support in a sell trade isn't very far away and your stop loss is too high, then that's not a proper risk-reward, and this clearly is not part of your plan. So if I go on this spreadsheet, I say here's the buy situation, which is the exact opposite of the sell situation. You need to stick to it. So if I have that plan and I only enter trades when I see this list of criteria, which is 5 criteria, positive, you may miss out on a lot of trades, but then again, you may be protecting yourself. So I can make some notes on this as well. I want to plot support and resistance on the daily charts and up and above and below the 4-hour chart. I make sure I check my economic calendar, and I make sure my stop loss is a maximum risk of 1%. So that's a simple plan. You could use any strategy and create a bunch of different plans for that matter, as long as you stick to that particular plan. I have different plans for different time frames. When I'm trading the news, I typically will look at the 5-minute and 1-minute chart. When I'm trading chart patterns, I will typically look at the 1 hour and 4 hour chart. And if you look at the two different plans, they are completely different, but I follow my plan. Okay, so let's say you're trading along and you realize that you need to tweak your plan. Nothing wrong with that. So here we are, we've tweaked our plan. We've changed our EMAs. We've gone a 5-period exponential moving average, which is a bit faster, crossing a 28-period moving average. Everything else is the same. We've added stochastics now instead of MACD. And we've actually added the reversal indicated by the parabolic SAR, which means that this particular trader probably wanted a more conservative strategy because the parabolic SAR is a more conservative indicator. So again, you may want to go the opposite way. I mean, I typically will go not use a MACD. I will use a stochastic oscillator because I find it's less conservative and faster. Other traders, as I say, love MACD. So it all depends on your strategy, as long as you write it down and as long as it's in your plan and as long as you follow it. Okay, boring, a journal. Who does that? Boring. Well, a lot of people do, and there's a good reason for it. As I mentioned earlier, I was trading for a hedge fund in the US, and they insisted that we keep a journal. In fact, they insisted we took screenshots of our trades. And we had to submit these every week. And I'm dead serious about this. So creating a journal, especially if you're a beginning trader, is absolutely critical based on your plan. So here's a quick spreadsheet I've drawn up showing a journal. I talk about the pair that I was trading, what time frame, what the situation was. In this particular case, it was my moving average cross strategy. When did I enter it? Sell, buy, what was the price? So if you take a look at the top line, well, this one, the trade, I lost 26 pips. I got stopped out. And when I look back at it, I realized, well, I sold too close to support. So I didn't follow my plan properly. The second trade did very well. I made 128 pips. Perfect trade, exited at predicted support. So if you create a trading journal for all your trades, I know it's hard work. I know it can be boring, but it can be very, very valuable. So add that to your list of goals for the year, create a trading plan. And again, it gets back to discipline. If you can discipline yourself, you can create a trading plan. Even when I'm scalping the news, I will typically write it down and find out where I went wrong. And again, trading as a professional, in one case, I was professionally obligated to keep that journal and to submit it and to provide screenshots. Right. So again, as part of the description of this webinar, we talked about succumbing to emotional trading. Again, I'm going to say over and over again, stick to your trading plan. There are a lot of ways to blow up an account, and one of these is moving your stop loss, getting nervous. Your trade's going the wrong way, and you think, oh, I don't want to get stopped out. My ego is too fragile. I don't want to, I want to have all my trades in profit. Well, that's probably not going to happen. And I have done, I tell you, hand on heart, I have done studies with live accounts where I've traded for a few months with very tight risk management using stop loss, and you end up losing trades, you end up winning trades. But at the end of the day, if you've got a very beautiful looking chart showing a progression of profit, that's what you want. I've also done studies where I've used live accounts with real money to trade without a stop loss. And yeah, you can actually make a lot of money. And I found that in the short term, you can actually make a very, very high profit. But what happens eventually, and it always happens, is that you get into a trade and something goes wrong, and it stays wrong for weeks and months. And you end up, and your broker, by law, will have to start closing trades, even though you don't want them to, because you've actually breached your contract with that particular broker, where you need to maintain a certain amount of margin. And what happens there is you can't show that particular graph to a professional or to a hedge fund, because your floating P&L will be an absolute disaster, even though you're making a profit. So very simply, I've done the studies, trading with stop losses and risk management ends up being more profitable and easier and certainly less stressful than trading without a stop loss. Having trades run into the negative, into the red for days on end is very stressful. And also, if it eats up your margin, you won't be able to trade anyway. So stick with your stop loss. Stick to your discipline. Get used to losing some trades, but stick to your plan. Okay. After a profitable trade, stop trading for the day. Okay, I'm going to tell you a little anecdote of mine where I was trading with the hedge fund, and I wasn't having a bad month, but I wasn't exactly lighting the world on fire. And then right near the end of the month, I had a day where I started trading at 7 o'clock in the evening based on American news, and I ended up closing my trades on 4 positions at 3 o'clock in the morning. And I made 2.5% of my account in a matter of hours. Well, of course, my investor was over the moon. They loved it. And he said to me, Brad, don't trade for the rest of the month. And it wasn't because, well, there are 2 reasons for that. One was because, as I mentioned earlier, a trader who gets really cocky and gets overconfident can start making mistakes. But more importantly for the investor, the end of the month was coming up and they wanted to be able to show a profit. So they didn't want to, and we say this, we have a phrase we use, giving it back to the market. So if you have a really, really good trading day, turn off your computer, go do something else, because you should be proud of yourself. You've done a good deal, a good day's trading, and you don't want to give that money back to the market. If you have a bad day, it's the same story. Stop trading for the day. Literally turn off the computer. Something's gone wrong. Things aren't working. The markets aren't right. Your head is not in the game. Just stop trading. And that should be part of your plan as well. It's quite simple. I knew a professional trader who told me if you made 5%, if you lost 5% of your account in one day, in those days, if you're working for a broker, you had to make margin calls. You had to phone. You were made to phone traders who were losing to have them deposit money in their accounts, which was a bit of a punishment. But you were forced to stop and not come back even the next day, take 24 hours off. It was the exact same for this guy. If he won 5% of his account, he was told to go home, don't come back for another day, take tomorrow off, and we'll see you on whatever that was, Thursday, Friday. And again, it was for that reason, because overconfidence can actually do more damage than lack of confidence. Again, check the economic calendar. As I said earlier, there are a couple of ways to trick yourself in building confidence and trying to eliminate trading psychology. And one way is to have somebody else watch your trades. They don't even have to be a trader. It could be your spouse. You could be trading during the day, and then go show your spouse at the end of the day and say, hey, look what I did today. They may not have a clue what you're doing, but if you can show them where you lost and even try to explain where you lost and why you lost, or how much you won and why you won, the fact that you're accountable to somebody else and not just sitting in your bedroom or on your laptop trading will give you a lot of confidence and keep you focused. Obviously, if you have other traders that you know, friends, colleagues who are trading, share tips with them. And that's I do that a lot. I share tips with friends around the world as we're trading. I see this, they see this. But it also keeps us honest because they know how well I'm doing and I know how well they're doing or not. And that is a really good psychological trick to help you ground yourself and not make any stupid trades. If you're totally on your own and you just get cocky or you're revenge trading, as we call it, you will start to make mistakes. I heard an anecdote years ago about treating your trading account as if it's your livelihood. Imagine if you're a chauffeur and you have a beautiful Rolls Royce and you get a lot of money for driving people around, and you take good care of that car. You polish it, you change the oil regularly, you make sure the tires are within code and everything is tickety-boo, and this is your livelihood, this particular car. Well, if you treat your trading account and your capital in that account as if it's your livelihood, you will be far ahead of the game and be very serious about it. And there are a lot of reasons for not treating your account that well, and a lot of them have to do with maybe not having enough money in your account. You don't take it seriously. There are many ways to do it. I heard an anecdote from a professional trader many years ago who said he was giving a speech in a seminar, and he said, pretend you're trading for the Chechnyan mafia. That's exactly what he said. So after the seminar, I went up to him and I said, oh, well, thanks for that. That's a good anecdote. And he said, no, it's not an anecdote. It's a real client. He says, I know a guy who actually trades professionally for the Chechnyan mafia. And he's trading $2 million. So he doesn't like to make mistakes. He obviously wants to be, and the stress must be incredible. Apparently it's a true story. So pretend you've got an important client who is looking over your shoulder trading. That may not work for you, but it's another way to keep yourself grounded. Right. Don't follow your friends. And we all hear this. You hear of your friend is, hey, I'm short on oil and doing really well. And you quickly rush to your phone or your platform and you go short on oil, but you may not have all the information. You may not know that he's been short on oil for a week and a half, and now it's too late. Don't trade on hunches or rumors. And I know I said I watch Bloomberg, and I've also seen people make big mistakes because they follow the news, and it doesn't matter whether it's Bloomberg or Yahoo Finance. If you don't check out the reason for something, you may be falling into an erroneous trap. And it won't be because somebody gave you bad information. It could be just because somebody got excited. And also let profitable trades run if you can. You will hear us talk about fear versus greed. And fear is closing trades too soon. Greed is letting trades run too long. And this is something that you will have to get used to. And depending on what you trade, depending on what time frame you're trading, you will have to succumb to fear versus greed, and it's a tricky one. Okay, right. I'm going to end the webinar now. Hopefully, I've filled you with. Hopefully, I haven't confused everyone. I've imparted my experience over the years with trading plans and trading psychology. It's a very complicated topic. And I'm going to end with a little advertisement for Valutrades signals. Take a look at Valutrades signals, sign up, it's free, and you may want to use these signals as part of your plan. You can see that they give you a very detailed list of analysis for every signal, and it may give you confidence, it may help you with your plan, but regardless of what you're doing, whether it's trading on your own, doing your own analysis, following my videos, for example, or trading signals, stick to your plan. Anyway, thank you very much for watching. I've enjoyed this. If you have any questions, just pop onto the Valutrades customer support line on the website, and we'll see you next time. Thanks a lot.